This is lesson 2 of the Seido Trading Learn to Trade series. In lesson 1, we learned how to identify trading range candles, bullish and bearish candles, and strong bull and bear candles. This lesson is the next step, reading those candles in context. We will look at how momentum forms, how traders behave around the highs and the lows, and the characteristics of trading ranges and momentum. This lesson will bridge the gap between your candlestick recognition and understanding pure price action as a behaviour. Every candlestick communicates important information about price. The open, high, low, and close are all inputs in how we read price and make informed observations about where it may move next. Of everything a candlestick chart shows, the close is the most important component. Traders backtest strategies and make decisions based on the close. Traders pay particular attention to swing closes. This is a 5-minute chart of the Nikkei mini futures. Price traded in a bull trend early in the morning. We set up a high close here. I want you to pay attention to how price responds as we push into that high close. We get an immediate push through. We now set up this high close. What happens when price comes into this high close? Again, we push through. Now finally, what happens on this high close? As price trades back towards the high close, it can't push through. Traders are selling in front of the high close, and this sets up this resulting behavior. That's a great example of where the wick of a candle is informing us of how traders are responding to a level. Wicks are also useful when placing stops, so traders will put stops past the extreme of a swing point. Traders who buy in the first swing will put their stop below the wick of the first swing up. Traders who buy in the second swing will again put their stops below the swing low. Price trades to a high and low on the first candle. Price explores lower. This wick is telling us that price was bought up below the low of the opening candle. This wick is telling us that price was being sold above the high. This wick here can still show strong selling pressure. The lack of the wick on this candle, traders are buying strongly into the close of the candle. We've now had 3 consecutive bull bars. The wick on this candle tells us that traders are buying in front of the low of the prior candle. By the time we get this candle here, we've had 9 candles that haven't gone below the low of a prior candle. This trading range candle tells us that prices below the low of the bear candle were bought. And the strong follow-up bull candle confirms the continued momentum. Bars without wicks, shave top, shave bottom, or both, show the relative strength and eagerness of market participants to get involved. So in this example here, bulls were buying on the open. They continued to buy it into the close. Gaps are the clearest indication of momentum in the market. Roughly 80% of all bars on a chart are trading range bars or overlapping bars that form part of a larger trading range. When gaps appear, they stand out as clear observation of directional momentum. There are 3 types of gaps that price action traders observe: wick gaps, body gaps, and opening gaps. Wick gaps require a 3-bar pattern. This is the bear case shown. The low of bar 1 and the high of bar 3 create the gap. There are gaps between bars 2 and 4, 3 and 5, and 8 and 10. Gaps also appear on a larger scale, between swing lows and pullback swing highs. Rather than using the wicks to form gaps, we can also use the bodies. That is the open and close of adjacent swing highs and lows. We call these body gaps. So on this example, there's a body gap between bars 1 open and bar 7 close. When gaps form both on individual candles and across swing points, it reflects strong bearish momentum. The final type of gap is an opening gap. These refer to the opening price of the following candlestick relative to the closing price of the prior one. We call these gaps buy the close or sell the close gaps, BTC, STC for short. So in this example, we can see that bar 1 close gapped up to the open of bar 2. Bar 3 gapped down to the open of bar 4, and bar 8 again gapped down to the open of bar 9. Markets tend to continue doing what they have been doing. A general observation to carry forward is that roughly 80% of breakouts fail. Price action that looks like this, tight trading ranges, can be very difficult for developing traders to navigate. Characteristics of this type of price action include trading range bars. Lots of large wicks, either on the top, the bottom of bars, or even both. You occasionally get strong bars, but the strong bars have no follow through. So a strong bull bar may be followed by either a trading range bar or even a counter direction strong bear bar. There's either no gaps or the gaps that form quickly close. And trading ranges are largely classified by a lot of overlapping price action. This does not mean this price action cannot be traded. What it means is that for developing traders, it is not the straightforward opportunity. Cleaner, more directional price action tends to produce clearer conditions while you're still learning. There are 3 ways momentum appears in the market. We call these type 1, type 2, or type 3 momentum. So type 1 is a single, very large, strong candle. Type 2 is at least 2 consecutive strong candles in the same direction. This is the reason why we learnt what a strong candle was in lesson 1. And finally, type 3 is a series of bullish or bearish candles that move steadily in one direction. Individually, you may not see strong candles or gaps on the chart with this type of momentum. But from a higher time frame perspective, it would still appear as either consecutive strong candles or a single large strong candle. Momentum provides some of the clearest opportunities in the market, so understanding these 3 types of momentum will form the foundation for how we observe and respond to price moving forward. This is an intraday chart of the Nasdaq futures, which highlights 2 very important points concerning the appearance of momentum. If you're trading intraday, you'll often see a large strong candle or signs of momentum at the open, as we do here. Momentum this close to the open does not produce reliable directional strength. Strong candles and directional movement near or at the open often reverse. Another time traders have to be wary of momentum is late in a trend. So as we see here, we're getting the largest candle of the day late in the trend, at least 10 to 20 bars in. This can indicate the end of the trend. Traders call these exhaustion or climax candles. This is a chart of the E-mini S&P futures. In this example, we've got 12 consecutive candles where the high is lower than the high of the prior bar. Anytime we see 6 or more candles like this in a row, in either a bull or bear trend, it creates a reluctance or hesitation from the opposing traders to take counter-trend trades. In this example, what that means is they'll often wait for a second attempt to reverse prices higher. So even if we get a strong bullish candle like we did here, traders may hold off. It's when the second bullish candle forms, a second attempt to push prices higher, that bullish traders gain confidence and participate. This is another day on the E-mini S&P futures. I want you to pause the video for a moment and examine the chart. What are the characteristics you see? Are there strong bars and momentum? Were there wicks on the bars? Where were they? Are they showing a directional bias? Are there any gaps present? How did traders respond to the presence of the first bull bar? And what happened the first time as prices traded through the low close? What happened the second time when prices traded back down to the new low close? And how did price transition from momentum to trading range? Were we getting more signals of momentum or less? All of the characteristics of candlesticks and momentum are important tools to assist your read of price. Before the next lesson, pull up your chart and identify all the candlestick characteristics we've discussed. Annotate 2 full days of charts with the features below. The more effort you put into reading price at this stage, the easier it's going to be later on. So that's it for lesson 2. There was a lot, so well done for hanging in. You now know how to read candlesticks in context and key signs of momentum and trader behaviour. Lesson 3 covers trends, how to identify them, and how to stay aligned with them. I'll see you there.